Today, gold tops the 4K mountain, so where next? Well, again, it's Martin North from Digital Finance Analytics World. That is post covering finance and property news. Gold reached and briefly surpassed 4,000 US dollars an ounce, and it's now traded from the $2,000 levels just 2 years ago, with returns that are now outstripping those for equities this century. Gold has jumped more than 50% this year. This new record is both a market milestone and a signal of deeper macro political stress, and importantly reflects a broad flight to safe assets amid current geopolitical shocks, policy uncertainty, and weaker dollar momentum. Now we can sheet the melt up to that range of factors. The geopolitical and political shocks have increased risk aversion and safe haven demand for gold, including crises in major economies and sustained global tensions. We'd include here the US government shutdown and fiscal gridlock, trade war, which have escalated under President Donald Trump, especially tariff-related inflation concerns, and the political instability, including crises in France and Japan. And we'd also add in AI-driven tech stock bubble fears, with 35% of S&P 500 firms trading at over 10 times sales. And we've seen large-scale central banks reserves diversify away from US treasuries. And that's supported persistent physical buying by sovereign buyers, notably from the People Bank of China and Russia. It's a shift away from fiat currencies, and central banks and sovereign funds are diversifying reserves, and by the way, are therefore not that price sensitive. The pace of buying doubled after the US and its allies froze Russian foreign exchange reserves in 2022, following the full-scale invasion of Ukraine. In addition, there are renewed expectations of the US Federal Reserve rate cutting, which reduces real yields and so improves gold's relative appeal as a non-yielding store of value. And a weakening US dollar this year has amplified dollar price gold gains and encouraged overseas demand. So the surge past 4,000 US per ounce for the first time in history is driven by those geopolitical and economic anxieties and a growing loss of faith in traditional financial systems. Analysts expect further upside, but also warn of volatility. While central banks were in earlier, now other investors' behavior shows a shift towards conviction-based gold holdings with a mix of physical bullion, ETFs, and options. Ahead, well, it could still go higher, with Goldman Sachs picking 4,300 to 4,900 by December 2026, although the Bank of America warns of uptrend exhaustion and a possible correction. Upside potential remains if the Fed continues easing, if the geopolitical tensions escalate, and the AI sector faces a correction. By the way, 95% of firms see no ROI from AI investments, at least so far. Downside risks include profit taking and technical corrections, the stabilization of global political conditions, and a potential rebound in the US dollar or Treasury yields. But it's clear that gold's rise reflects deep systemic unease stemming from a loss of confidence in fiscal policy, and investors are hedging against erratic government spending and debt sustainability concerns. And pause also to consider the buyer types and their preferred methods to hold gold. Central banks generally are holding physical gold in reserves, though in some cases are also lending and borrowing those bars, driven by de-dollarization and geopolitical hedging. Institutional investors like hedge funds, pension funds, sovereign wealth funds, etc., tend to be holding ETFs, futures, and options, and there is still a one-to-many relationship between the underlying gold supply and the speculative instruments riding on its back. This is motivated by portfolio diversification and inflation hedges, but can also lead to significant volatility. And we're also seeing a surge in retail investors now, with demand across Europe, Japan, and the US and elsewhere. Retail investors hold a mix of physical bullion, gold-backed ETFs, and leveraged options, driven by a quest for a safe haven and perhaps a distrust of equities and crypto and, well, frankly, governments in general. And we should also talk specifically about high net worth individuals who are increasing their allocations to vaulted gold and private storage, driven by wealth preservation concerns and in response to rising geopolitical risks. So, in summary, gold is no longer just a hedge, it's a conviction trade, reflecting deeper doubts about political credibility. And it's likely the diversification to gold will accelerate with dips seen as buying opportunities. But also, we should expect volatility, especially if AI stocks correct or if central banks shift their tone. There is a bull case ahead with a continued ascent between 4,500 and 5,000 plus, with sustained geopolitical escalation, additional Fed easing, continued central bank accumulation, and structural de-dollarization forces all driving further safe haven flows. The base case, which is a consolidation of around 3,000, 6,000 to 4,200, with periodic profit taking, technical corrections, and intermittent risk on episodes, producing volatile trading, but leaving the long term trend intact if macro uncertainty remains. And then there's a bear and correction case with a pullback to $2,800 to $3,400, rapid re-strengthening of the dollar, a conviction recovery in risk assets, especially a rebound in AR tech, or a clear reversal in central bank buying could trigger such a material correction. And there are a range of economic implications as well. The inflation and yield dynamics means the higher gold is a market signal that investors expect lower real returns on nominal assets and persistent policy uncertainty. Sustained gold strength pressurizes real rate expectations and can narrow central banks' room for stimulus normalization. In financial markets, a large allocation shift into gold would dampen liquidity for risk assets, widen credit spreads during stress periods, and increase hedging costs for institutions exposed to dollar weakness. And commodity and mining sectors means that miners' revenues and exploration activity could expand, supporting capex and potential supply responses. But production lags mean near-term supply cannot blunt price spikes. And sovereign and fiscal pressures means that countries heavily reliant on dollar financing could face higher refinancing costs if markets interpret gold strength as a derating signal for sovereign risk, complicating budget management in stressed jurisdictions. And of course, the broader political implications include de-factoring of dollar dominance, coordinated or unilateral reserve shifts, increasing geopolitical leverage for large gold accumulating states, and there's a potential rise in diplomatic friction over sanctions and financial assets. And domestic politics, which means things like the visible wealth transfer with higher gold valuations, changing the political narrative about inflation, social policy, and central bank independence, and intensifying the scrutiny of fiscal management in a number of countries. And the policy risks are there too, with markets perhaps pricing political interference in central banks or fiscal gambits as a higher tail risk in reinforcing the safe haven premium embedded in gold prices. We expect gold to reach a cyclical peak when there is greatest market concern about the outlook for Fed independence, Macquarie Bank analysts wrote. In the event, however, that a compromised Fed were to make clear policy errors, gold's performance should, of course, be even stronger. And that's a pretty good way to sum things up, because all of those scenarios that we've discussed are potentially viable depending on circumstances. And as I often say, when it comes to gold and, in fact, other markets, it's all about events, dear boy, events, because nobody really knows. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.